you, Kathleen. Can you hear me okay? As Kathleen said, I'm Steve Burke. I'm with Williams Mullen, and I'm in the corporate section and have been practicing for longer than many of you have been alive. But I'm sure that you may have questions, and at any time, feel free to interrupt me during the presentation about the questions. Our talk today is going to be about how to form an entity and what entity you should choose and what are the advantages and disadvantages of different kinds of entities. And what we see is that there's a real intersection between state law and federal taxation, which really drive the decision as to what kind of entity that you want to form. And there are primarily three types of entities that we see used in most business settings. Those are corporations, limited liability companies, and limited partnerships. Inside of corporations, there is a subset that really exists only for federal income tax purposes, and that's the distinction between what we call a C corporation and an S corporation. Those are tax concepts, not state law concepts. You can't form with the State Corporation Commission a C corporation or an S corporation. The only way you can do that is through through elections or not making elections with the Internal Revenue Service. So let's start with corporations. Or maybe we should just start with some of the things that are fairly common elements among all three. Why do people form entities? Well, there's a whole series of reasons why people will do that. The first is they want to limit their liability. They want to put in funds that are at risk, and they want to lose no more than those funds. And if they do that particularly through a corporation or a limited liability company, they're pretty much assured that they're going to have limited liability unless they perform some improper acts. And I'm sure you're familiar with concepts of piercing the corporate veil and that kind of thing. So, but people do it for those reasons. They also do it so they can bring in capital more easily. They do it to have an entity that lives in perpetuity, that the death of one or more of the owners doesn't affect the continuation of the business. And they also do it to have a way to bring in multiple parties into the same business, having different ownership percentages and different rights and obligations. So a client comes to you and says, my friend and I want to form a new business. We want to form a corporation, and that's what we want to do. Well, your choice and what you have to do is find out the reasons why your clients think they want to form a corporation or a limited liability company or a limited partnership. Very often they won't understand the reasons why, and you need to understand them and help them guide them. And you do that by asking a whole series of questions about what their goals are, and some of those questions are outlined in the materials. And they include, how will this business make money? Is it a high-risk business? Is it a low-risk business? Will it involve employees? Will it be licensing technology? Will it have valuable rights? Maybe they're going to be the sole owner of the business, or multiple owners, as is in the case I presented. Where is the money coming from? Is it going to be equity? Is it going to be debt? Is it going to be some combination of both? Do they already have an existing business that they want to transfer into this new entity? And what's the form of that existing business? How long do they plan to be in this business? Is this a short-term venture, or is this a long-term? Do they plan to operate it for kind of ever? Or is this an opportunity to build a business short-term and sell it to make profits? Will the entity have a number of employees? And if so, how will those employees be compensated? Is there any idea that you want to give them some share of the equity in the business, some stock options? Is that something that's going to be important for these business owners? will they work for the entity? Will they be employees of the entity? Or will they be passive outside owners and have nothing but hired management to work for them? So when you get all that information, you then look at your options. And our first option is with corporations. And so a corporation, as you know, you form a corporation by filing articles of incorporation with the State Corporation Commission. And then the incorporator does that, and then you go on and you form, you have shareholders, the shareholders elect the board of directors, the directors appoint the officers, and each of the roles of shareholder, director, and officer are very well defined in the Virginia Code. There's a whole series of what obligations each has. The rights and obligations of directors versus officers versus shareholders are well defined, and there's quite a bit of case law on it. There's particularly a lot of case law that comes out of Delaware, where most publicly traded corporations are formed, is in Delaware, but a number of other states have and use public companies. I personally have dealt with several Virginia public companies, and there are some advantages of having your public company based in Virginia, including the difference between the standards that is placed on directors in Delaware, which is an objective standard, versus the subjective standard that the Virginia courts apply. So if a Virginia director believes in his or her personal belief that he or she is acting in the best interest of the corporation, that usually is acceptable for the director not to be held liable, whereas in Delaware, the courts impose an objective standard, which raises the bar for directors. Now, so that would say that Delaware is probably a more friendly state for shareholders, and Virginia a less friendly state for shareholders. So you want to then understand who you're representing, and maybe we should just stop for a second and talk about that. One of the problems that we see come up over and over again is, who is the attorney representing? Two people come in to form a company. They're going to own it either 50-50 or 60-40 or in some way. And let's say in this case they're going to form the corporation, and they ask the attorney to draw up the documents. One of the documents that's prepared is a shareholders agreement, and the shareholders agreement deals with how you resolve a dispute between the shareholders. Well, sure enough, a dispute arises, and then the attorney who's done all this work goes in and talks to one of his litigation colleagues, or worse yet, a lawsuit gets commenced dealing with this dispute, and it's really not clear who the attorney was representing. Was she representing the entity? Was she representing the 60% owner? Was she representing the 40% owner? Was she representing everyone? And so unless you're very careful at the very beginning and explaining to the clients who you're going to represent, and generally you want to be representing the entity itself, and that each of the members, shareholders, partners is free to get his or her own counsel, can be good. Generally, though, what will happen is that you'll find that in these circumstances, the clients will agree that you can prepare the shareholders agreement and you can explain it to them. If disputes arise, very likely you will not be able to represent anyone in dealing with that dispute if that comes up. But so think about that as you're going forward. If you are very close to one of the individuals that is in this business, particularly if that individual has a majority stake, you may want to make it very clear from the outcome that you are representing that majority owner and not the minority owner, and that the minority owner needs to go find his own representation. So for federal income tax purposes, a corporation is a separate person that has to generally pay taxes unless it elects to be an S corporation. So we call those corporations that have not made this election, we call those C corporations because they're taxed under subchapter C of the Internal Revenue Code. And so essentially you have the circumstance where you contribute cash or assets into a corporation in exchange for stock. Generally, that transfer is not taxable unless the liabilities that are assumed by the corporation are greater than the basis that the contributors have in their assets. What's basis? Basis is this important concept in taxes that everyone understands generally, but is extremely important as we go through this analysis. So you know that if you buy a share of stock for $100 and sell it for $110, you have a $10 gain. The $100 you paid for the stock is your basis in that stock. And so when you sell it, you measure your basis against the amount you've received, the amount realized, and that gives you your gain. In connection with a depreciable asset, however, if I buy a depreciable asset for $100 and I'm depreciating it over 10 years at $10 a year, at the end of the second year I now have an $80 basis in my asset, and so if I went to sell that asset again for my $110, I'd have a $30 gain because I'd had the advantage of taking the $20 of depreciation in my earlier tax years. So again, going back to putting assets into a C corporation or an S corporation, it's essentially the same. Generally, it's tax-free unless the assets have liabilities associated with them, and those liabilities exceed the basis, and that can happen particularly if someone hasn't paid any principal on an obligation, but they've been depreciating an asset over a number of years. So you just need to make sure when you're going in what the assets are worth. Always advisable to get some kind of evaluation or appraisal of the assets if it's an ongoing business, so there's no question. So now you've got your assets in your corporation, you begin conducting activities and come to the end of your first taxable year, and for C corporations you can generally choose years other than a calendar year for your year end. And at the end of that year, the corporation is going to pay taxes based on the income that it's had during that year, or losses. The corporation will have a loss, and that if that loss can't be offset against any past taxes, that loss can get carried over to future years. So we have this separate entity. It's a self-contained entity. Then you go to make distributions out of that C corporation. Generally, they're going to be treated as dividend distributions to the extent that the corporation has had something called earnings and profits. But basically, if the company's making money and is making dividend distributions, it's likely the shareholders will have to pay tax on those distributions. And it's also and the corporation has already paid tax on the income to give them that earnings and profits. So we talk about the double taxation inside of C corporations. With S corporations, you make an election. Both the corporation and each shareholder has to make an election. There are many, many rules that apply with S corporations. First, only a limited group of persons can qualify to be a shareholder of an S corporation. Primarily, those are individuals. So you can only have individuals. Those individuals have to be, they can't be aliens, can't be foreign citizens. Only U.S. persons can be U.S. individuals. Generally, there are some trusts that can qualify to be a shareholder of an S corporation. You file your S election, and what happens in an S corporation is then it still computes all of its gain on its tax return, and then that gain gets distributed to the shareholders pro rata based on their shareholdings. When we talk about partnerships or limited liability companies in a minute, there are differences between the kind of income that flows out of an S corporation to the shareholders than what flows out to the partners in a partnership or members in a limited liability company. So there's only one level of tax at our S corporation, which is an advantage. The disadvantages are that because you can only have a certain class of persons to be your shareholders, you can run into problems in that regard. A few years ago, I did a large transaction, S corporation, with perhaps 30 shareholders. We found out long into the transaction that one shareholder had at one time transferred some stock in this S corporation to an IRA. The IRA was not qualified to be a shareholder of an S corporation. They were advised by the company that sold them the IRA that, oh sure, an IRA can be an S corporation. That was wrong. We ended up, and so the consequences, just talk about the consequences for a second. So you've had this S corporation that's been doing business for 15 years. All of its income has been taxed to its shareholders during that 15 years. The corporation itself has not paid any taxes because it wasn't a taxpayer. Everybody thought it was an S corporation. Well, if you find out retroactively that your S corporation was really a C corporation, then what happens is that the C corporation owes all of this tax. These shareholders who've received the income and paid tax on it, they've all overpaid their taxes. So they get to go back and file refunds for their taxes. Fortunately, the Internal Revenue Code and the Internal Revenue Service has adopted some fairly liberal provisions where if you've had a foot fault kind of disqualification of your S corporation, you can go back and get a private letter ruling that should allow you to maintain that status. Getting a private letter ruling is was expensive and time consuming. But on our transaction that was, I think it was in the $120 million range, the tax liability associated with this bad S election was probably going to be about $30 million. So it was a big surprise for everyone. So if you're ever representing, if anybody ever comes into you with a S corporation that's been up and running, you're going to want to go back and make sure about that they've complied with all the S rules. Another S rule is this one class of stock rule, and that says you can only have one class of stock in your S corporation, but voting and non-voting doesn't count as a class of stock. In typical IRS rules, there's only one class, but you can have different classes. But this non-voting stock is fine. You can have non-voting stock, voting stock. All other attributes of the stock have to be the same. So people got very creative with how they wrote their stockholders agreements or their stock redemption agreements. I could create essentially different rights and different values of my stock by what my stock redemption agreement said. So I could have, I could provide that on, when you leave the corporation, I'm going to buy back your stock at a discounted amount if you leave under these circumstances. Well, the Internal Revenue Service has found that can create two classes of stock. So you get this, again, second class of stock, and it's the same problem where you aren't sure, you may not be positive whether or not you've got a good, valid S election or not, because the IRS can look back at that retroactively and determine that you created a second class of stock through your shareholders agreement. There are some safe harbors where if you have certain magic language in your shareholders agreement or in your stock redemption agreement, you can avoid those problems, but you need to be aware that there is a problem there. Speaking of shareholders agreements, the Virginia Code has a specific provision that deals with stockholders agreements, and if you are preparing an agreement among stockholders that deals with the rights and liabilities and limitations and who's going to be the officers, who's going to be the directors and all of those things, you should definitely review that provision dealing with stockholders agreement. It has certain provisions that are important for you to understand how in Virginia it's going to be treated. Typically Virginia is pretty free in how you contract, but here in this circumstance there are some requirements in your stockholders agreement. There used to be a 10-year lifespan on your stockholders agreement that was recently removed, which is a good thing because very often people will, they'll get the stockholders agreement done, they'll put it in a drawer until somebody dies or retires, and then they'll pull it back out and they'll be surprised that what they find or don't find that's in there. So now we've had our corporations, we've got our C corporations, we've got our S corporations, and so the other thing about C corporations and S corporations is you can go from being an S corporation to a C corporation kind of at any time. As I said, sometimes you can do it involuntarily, but you can do it voluntarily too. You can go from being a C corporation to being an S corporation. Again, the corporation and all the shareholders have to file the election. Generally, if they file it before the end of a year or within the first 2.5 months of the following year, they can have it retroactive as of the first of either the following year or the year that they take the election in. But there are special rules that apply for built-in gains when we sell assets, and I'm going to talk about that a little bit later. The primary benefit or difference between C corporations on the one hand and S corporations and LLCs/partnerships on the other hand. So moving on to LLCs. Virginia has adopted the Virginia Limited Liability Company Act. There are these kinds of people inside of a limited liability company. There are members and there are managers. Those are the two statutory categories. A member is the person owning equity in the limited liability company, who owns a membership interest. A manager is a person who is appointed by the members to manage the operations of the limited liability company. If a limited liability company either does not elect managers or chooses to have it be member managed, then the members can manage the limited liability company, and this is referred to as a member, so we differentiate between these two being member managed or manager managed limited liability companies. The roles and duties of members and managers kind of overlap with those of shareholders, directors, and officers of a corporation. The Virginia courts have found that members generally, unless it's provided in the operating agreement is the statutory name of the agreement that governs the operations of a limited liability company. We'll spend a little bit more time on those later. But the default is you have a member-managed entity, but the members do not have fiduciary duties generally to the other members, just as stockholders do not have fiduciary duties to other stockholders generally. There are some circumstances where that doesn't apply, but generally there are no kinds of fiduciary duties there. Managers are generally thought to have fiduciary duties. Managers are generally thought to have fiduciary duties to the members. Again, the extent and the amount of those fiduciary duties can be greatly modified in an operating agreement. So an operating agreement kind of takes on the role of that you would expect to see in the bylaws of a corporation and in a stockholders agreement, and all of the tax provisions that you'd expect to see in a limited partnership agreement. There is, if you have more than one member to your LLC, there is kind of no such thing as a simple operating agreement. These are complex agreements, primarily tax-driven. So we're on taxes now. So let's talk about how limited liability companies can be taxed. Limited liability companies are generally taxed as partnerships, although you have the ability to today check the box and have them taxed either as a C corporation or as an S corporation. If you do it as an S corporation, you've got to meet all your requirements of an S corporation, and it just seems to be, there can be some advantages in doing that. Almost everyone ends up having their LLC taxed as a partnership, and for purposes of our discussion today, I'll assume that. The big exception to the partnership, however, is if you have a single member LLC. That entity is disregarded, a disregarded entity for purposes of taxes. So if an individual owns 100% of the membership interests of an LLC, he or she it just shows up on that person's 1040 as on a Schedule C as a business. If a C corporation owns 100% of the membership interests of an LLC, then it's just treated like a division. It's not respected as a separate entity. It's not a separate tax-paying entity. Whereas if I have a corporation that has subsidiaries, if they're all wholly owned, they're going to file a consolidated return. But if you have a corporation, a C corporation with a series of LLCs underneath it, it's as if from a tax standpoint those entities don't exist, and it can be better and easier for the purposes of preparing the return. And a lot of times we will see that either we'll form a whole series of LLCs under a joint venture, primarily to isolate a liability in assets. So, for example, somebody who wants to operate a whole series of nursing homes, what you'll see they'll do is they'll put each nursing home into a separate special purpose LLC entity. The idea is that I'm going to isolate the liability in that one nursing home from all of the others. And then obviously the plaintiff's lawyers come in and try and figure out how to attack that structure and argue that it's, it's not a standalone, well-respected entity. And if you're doing that, obviously it's very important to maintain all of the LLC or corporate formalities in doing that kind of a structure. But the idea in doing this, limit liability, but limit the number of returns and the complexity of the tax returns that you have to do when you do it. So we're talking. So now going back to our LLC as a partnership, and limited partnerships are taxed just like LLCs, except you can't have a one member partnership. You have to have at least two partners. If it's a limited partnership, you have to have a general partner and a limited partner. If you have a general partnership, you can have two partners. Other distinctions are that you can have entities be members and managers of LLCs. Entities can be shareholders of corporations, but entities cannot be directors or officers of corporations. You can establish officerships inside of your operating agreement for an LLC or a limited partnership. That's permissible under the flexibility that you have there. They're not required, as generally they are in corporations, unless you've somehow decided not to use corporate officers through your stockholders agreement. So how are partnerships / LLCs taxed that are not single member LLCs? Well, all items of income, gain, loss, credit, and deduction flow out to the partners / members based on their membership interests in the partnership LLC. You can have multiple classes of membership interests. You can have them preferred. You can have them what we sometimes call promote interests. We use those kinds of interests where there's a joint venture entity puts money into the venture to get it. Management has this interest, and they start out at a 20% interest. But after the joint venture entity, the investor entity gets back its return, it gets back all of its money and some return, then what you'll see is that percentage interest of those working partners, the sweat equity, their interest gets promoted from 20% to 40% or 20% to 60%. And these are very complicated provisions, and how they're taxed is important to understand basically if you're getting into one. Just like a corporation, you can contribute generally assets and liabilities into a partnership and it's not going to be taxable. The rules are a little bit more forgiving on the partnership side. The advantage with partnerships is you have huge flexibility in how you're going to structure the allocation of gains and losses. It has to have substantial economic effect. The real problem with limited liability companies and partnerships is that you have great flexibility. And if you're not careful on how you've used that, you find yourself that you've created problems that where in the corporate setting you could solve because there is a pretty clear roadmap as to how to deal with problems, whereas in LLCs you don't have that circumstance. So during a year, a partnership will go along. It will have its operations. End of the year, tax return gets filed. Each of the partners gets a K-1, and it just flows through each of those percentage interests that they have, goes out to the various partners, and they include that on their tax return. It's pretty straightforward. One level of tax. Generally, LLCs are partnership of taxations, while complex, gives flexibility, but what it also has is this one level of gain. Generally, there's only one level of tax. So let's think about our corporation, and I'm getting ready to sell my business. The business has been operated for a long time. We'll assume that it's worth, $11 million. All of the assets have been fully depreciated. I'm going to use a simple kind of an example. The owners of the business come into you and say, we got our business here. We're ready to sell it. What should we do? I've heard that the buyer told us that they want to buy our assets. So your first question is, are you a C corporation or an S corporation? How are you taxed, or are you taxed as a partnership? That's your first question. If they say, well, we're taxed as a C corporation, then you're going to say, well, you're probably going to have to sell the stock of your C corporation, and I'll explain that to you in a second. If they come in, the next question is we're an S corporation, then your next question should be, have you always been an S corporation? Because if you've not been an S corporation for more than 10 years, then when you converted from being a C corporation to being an S corporation, there was a built-in gain that got established on the date of conversion, and that built-in gain is subject to double taxation. And we'll talk about the double taxation in a second. So your third question is, if they're a LLC, you say, great. It doesn't make any difference whether you sell your membership interests or your assets of your LLC. It's going to be taxed as if it were an asset sale anyhow if you're selling 100% of your membership interests. So that makes it easy. So okay, so it's a C corporation. So what happens is on $11 million of gain, the company's probably going to pay somewhere around $4.2 million in taxes at the state and federal level. Then it distributes the remaining $6.8 million. The shareholders are probably going to have tax of another $1.7 million on top of that. So you get this double taxation that makes it really almost impossible for a C corporation that doesn't have loss carry forwards or some other extraordinary reason to sell stock economically. And this can really be a problem, particularly if there's a good reason why you need to sell stock, or why a buyer would want to buy stock. And those reasons can include that you have certain assets that can't easily be assigned to an asset buyer. The party on the other side won't allow you to assign this very valuable patent license, but if they buy the stock, it goes over automatically. Government contractors also have to go through a difficult process with the U.S. government when they're called novation, if they're selling assets and trying to get the contracts assigned. And you don't usually find out until after closing whether or not this assignment is going to be really effective. So we often see that there are reasons why people have to sell C corporations, the stock of C corporations there, and pay this double tax. Are there ways around it? Yeah, there are some ways around it that we've come up with. Sometimes you'll have a valuable employment contract. Sometimes there's the concept of personal goodwill, but these can be aggressive tax planning ways to go. But it's much easier if you found out that you've got an S corporation, that's always been an S, or a partnership. In that circumstance, generally there's one level of tax. It gets taxed to the shareholders or of the S corp or the members, and they go on their way. It's taxed at the individual rates, not at the corporate rates, and it's much more advantageous. Generally, when we're looking at, when we look at the difference between the value of a company and as a C corporation and a limited liability company versus S corporations, I'll start over again. C corporations on the one hand are either worth about 20 to 25% less than an S corporation or a limited partnership taxable entity. And this is because of when the buyer of the stock purchases the stock of a C corporation, the buyer cannot step up the basis equal to the fair market value. So let's go back to my $11 million example. I've got $11 million worth of assets in my C corporation. They've got a zero basis. I can no longer depreciate them any further. So the buyer of the C corporation pays the $11 million, wouldn't pay $11 million, but pays the $11 million in my example, and those assets can't be depreciated any further. If I buy the assets from a stock corporation, from an S corporation, or from a limited liability company, those assets get stepped up to fair market value. And any assets that are not based on the assets for fair market value, anything that's left over goes into kind of a goodwill category. The goodwill gets amortized over 15 years. So if you think about how you want to approach this, if you think about it just simply, is you just take the present value of the purchase price, take your tax rate, assume a 40% tax rate, take a present value analysis over your period, over your 15-year period, and you discount that back using whatever discount rate you want to use. That's how you kind of come up with your difference in value between doing a stock deal and an asset deal when you're dealing with C corporations. So it's just one of those factors. Now, if you have an S corporation, you can sell the stock and have it treated as an asset sale by making certain elections under the Internal Revenue Code, and it gets the same basis step up similar to the way that you would see in a partnership. And as I said, in the partnership, you automatically, the assets treated as an asset sale, even if you buy the membership interests or partnership interests, and gain or loss gets recognized based on the difference between the amount paid for those assets and the value paid, and then you take into account the partners or members outside basis when you wind it all up. So it's fairly straightforward. So let's, again, talking about changing our form of entity. We talked about going from a C corp to an S corp, and an S corp to C corp. Can I go from being a limited liability company to being a partnership and vice versa. You can change the form of the entity through a process known as conversion, and there's a typo in the outline where it says it's a conversation, it's a conversion. Spell check did not catch that, but what can I say? Not good proofreading. So you can convert from going from being a Virginia corporation into being a Virginia limited liability company and vice versa. You can convert you can convert a general partnership, can convert into an LLC, and then you can convert the LLC into a corporation if you want to do that. You should be aware that there can be tax consequences if you go from being a corporation into being a partnership. It's a recognition event. It's as if you sold all the assets of the entity for their fair market value and then contributed in. It's just a big problem to convert without considering the tax consequences. However, converting from an LLC into a corporation is generally tax-free. It's treated just the same way as we talked about when you make your contribution of assets. The only thing you have to worry about is what are your liabilities that are being assumed by the partnership. Okay. You can merge the entities together. That's another way to do it. People will just set up a shell, merge them in. Either way, you can merge LLCs into corporations and corporations into LLCs. You can merge LLCs together. You can do lots of things with your merger. If you want to change your form, generally, a merger can be structured as being tax-free between two C corporations or between an S corp and a C corp. But again, there are possibilities. So let's talk about internal to your entity, shareholders versus members of a limited liability company. So if a shareholder dies, and we have an individual shareholder, we'll assume, nothing happens to those shares, then pass to his or her descendants. Nothing happens to the voting rights to those shares. The descendants get to vote them just the same way that the decedent could have voted his or her stock. They have the same rights to dividends. If they have got preferred stock, everything remains the same. There's a concept in limited liability companies called dissociation, and it's a very important concept for you to be aware of in planning your in planning and dealing with your clients. So what happens is, under the statute, if a member dies, that member becomes, an individual member becomes disassociated with the LLC. And by statute, his interests become non-voting, no right to vote, and only has the right to receive distributions from the LLC if they're ever made. So there was a fairly recent Virginia case where an individual died holding, I think it was 70% of the membership interest in an LLC. The operating agreement provided that he could transfer those to any of his children without, and that child would be entitled to take those membership interests and continue to vote the shares. So what happened was, the individual dies, transfer the shares to his daughter, daughter takes 70%, mother was the manager, daughter removes mother as manager, takes some other actions on behalf as if she were the sole voting shareholder. Then filed a declaratory judgment action to affirm that she had the right to take all those actions. So case gets up to the Supreme Court. The Supreme Court says, well, we really don't care what the operating agreement said in this point. She didn't take voting rights. She only had no rights to vote. She only has an assignee's interest, and it doesn't work. Well, fortunately, the Virginia legislature modified that case, reversed it by changing the statute to make it clear that your operating agreement can provide that an interest of an individual who dies automatically transfers at his or her death, and those interests remain voting and don't become assignees' interests. I'm currently dealing with a situation where the manager, primary owner of a LLC died. The agreement did not have the automatic transfer language in it, and we're currently representing the estate, and because of some issues in there, we're not sure we ever want the estate to have voting interests in these LLCs or have control, and the other minority members are kind of trying to figure out what in the world they're going to do with this. But so be careful about dissociation. You can be dissociated for other reasons. It can be for disabilities, and your operating agreement should spend time really dealing with this dissociation issue. Buyout provisions. What happens if there is a dispute between the two 50-50 members, two 50-50 shareholders, or 60-40? It's very important that your shareholder agreement or your operating agreement deal with these deadlock issues. The court system is inefficient for kind of resolving these kinds of disputes. The most popular one that we see in these circumstances are what sometimes referred to is the Texas buy-sell provision, the Texas shootout, the cross-purchase provision. They all generally work kind of on a modification of something like this. Let's suppose we have two 50-50 shareholders in your corporation, A and B. Each has the right, after certain events occur, such as a deadlock, they can't agree on a major decision, to buy the other one out. So the first one shoots and says, I will either pay $1 million for your half of the company, or I will sell you my shares for $1 million. So at the end of the day, we've got a purchase price that gets established by the shareholder who shoots first, and then the seller has a choice of whether to buy those shares for that $1 million or to take the $1 million and go away. There are some nuances that you want to think about, particularly if you're in the circumstance where you have a very wealthy shareholder A and shareholder B, who has worked in the business forever and really grown the value of it, can't afford in the 10-day period that's in the agreement to match the offer or not to raise the $1 million. So you have to consider carefully those circumstances and how long it reasonably should take shareholder B the time to raise the funds to be able to buy shareholder A out for $1 million. Sometimes, though, we find that there are loan agreements in place that don't allow this kind of buyout to occur because it's a default under the loan if either A or B ceases to be a shareholder. So you need to take into account these kind of outside events and whether, and there could be some kind of other extraneous events that may apply here. So that cross-purchase can work. There are other ways to do it. Some people will have an appraised value formula. You go get an appraiser. The appraiser comes in and tells everybody. You have a choice on your cross purchase as to whether or not the entity is going to end up buying it in a redemption transaction or whether it's going to be a cross purchase. Some companies will use life insurance to fund the buyout of those shares. If you have multiple owners, you want to think about where that insurance is going to be held. Is it going to be held outside of the entity, or is it going to be held inside? And this kind of planning for people don't live forever, and it's important, and it's really important to think about those things and the time to do it. I mean, it's a little bit, think of it kind of like a prenuptial agreement. You know, when everybody is happy and smiling, they should be able to figure out how to figure these things out. Been involved in a number of very, very difficult and serious shareholder disputes, and it can be very difficult to work through them, and you look at your agreement and it's really of no help in resolving this dispute. Sometimes we will see in these cross-purchase agreements that there can be kind of a cause issue. If the person who's defaulted, if somebody's in default of the terms of the operating agreement, he or she can't shoot first in your buy-sell, if you want to have some cause effect. All of these methods, these cross-purchase methods, have some, aren't perfect in every circumstance. If you're dealing with individuals who have 5 or 6 different companies that they're in together, we find that you have to lump them all together, because if they're fighting over one company, they're fighting over all the companies. And you could have one comprehensive agreement dealing with the sale of all of the membership interests or all of the stock of all of the entities if that occurs. The problem is you get very valuable businesses, and if you get into these disputes, what happens is the value of the business goes down, and very often there's just not an adequate kind of determination of the value. So, what do you recommend to your client? What should you do? What's my recommendation? Well, what I find is kind of in the past several years, I have formed very, very few C corporations or S corporations. I'm forming primarily limited liability companies for kind of 3 reasons. One is they are very, very flexible. The second reason is there is one level of taxation for ongoing operations, and the third is that that on the exit there's only one level of tax, and everyone goes into business to make money, and they want to keep as much of that as they can and not pay it to the IRS. So for those reasons, we're seeing more and more limited liability companies. They're being formed kind of everywhere. Again, Delaware, a lot of LLCs are formed in Delaware. A lot of LLCs are formed in Nevada. Virginia has quite a few formed here. We like working with Virginia forms. We think the Virginia statute answers most questions. The Ott case that I mentioned before, where the Supreme Court seemed to take a weird position on, was just wrong. The legislature acted quickly to remedy that problem, and I think we can expect that in the future. We've seen that in the Virginia Stock Corporation Act, where there's a problem in the statute, the legislature generally very amenable to amending statutes in those cases where there's a problem, or where some other state has got some new legislative device that makes that state more attractive. These corporations are a big source of fees for all of the states, and so they want to make sure that their state is attractive. Does anybody have any questions? Questions? Yes.
Is the S corp election only for a corporation, or is that something else within an LLC?
You can make an S election by checking the box in an LLC as an S corporation, but you have to meet all of the S corporation requirements. One class of membership interests, only individuals can be members. no more than 100 individuals can be shareholders. I mean, there's all of those same rules apply to that entity.
And I think you said it can go back to the year that you're filing? Or
Yeah,
can
if
go
you,
for the next year?
for a calendar year, you can generally, if you file by March 15th, you can elect retroactively to January 1 of that year. That same year. That's the only, that's as far back as you can go. 2.5 months, 2.5 months of the beginning of the fiscal year. Generally, partnerships and S corps have to be on a calendar year for tax purposes. There are some exceptions to that, but that's the general rule. Yes.
Single member LLCs.
Yes.
Also apply to spouses.
Yes, if they're joint filers, yes. I mean, if they're, yeah, they can, if they're joint filers and the husband and wife own, then they have to file jointly, and then it's a disregarded entity. Anything else? Thank you very much.